Beyond traditional investing. Hi, I'm Dave Grant. I'm a certified financial planner and the founder of Retirement Matters, a financial planning company based in Barrington. The basics of investing are the same for everyone. But what different approaches exist once you've taken the initial steps? Investing is a challenging topic, and one that we've addressed from various angles on the Retirement Matters blog and YouTube channel. But there are times when I meet with clients or discuss topics with other people in which they've done everything that I would suggest. They max out their Roth IRAs, they make contributions and even max out again their 403b and 401k. They are contributing to 529 college plans for their children. They're making investments in a taxable account. All the things I would typically suggest they have done. So for most people in this situation, they have a large surplus of income as they're making maximum or sizable contributions to these accounts. And they're looking at over $30,000 per year per person to be able to do all of these things. While taxable investing doesn't have an income limit on it, when families are investing more than $50,000 a year to an account like this, on top of their retirement savings, it can be time to look at other investment options. Investing in real estate. As a prudent advisor, my advice for people is to pay off their house first before investing in rental real estate. Now, some clients agree, others look at me like I'm from outer space. Now, either way, it's their money to invest, and they can choose what they want to do with my advice. Now, whether you pay off your home first or not, purchasing rental real estate can be a way to generate income now, to either pay down the rental mortgage or use for other purposes, and also purchase an asset which will appreciate until a future time in which it's sold. While the amount of appreciation is very location dependent, it can be almost guaranteed, I hate that word, but by purchasing houses at well below the market value. Now this requires research, timing, and some luck, but investment real estate can be an added diversifier to a portfolio. When it comes time to retire and your rental property or properties are generating income each month, this can help you delay withdrawing funds from retirement accounts and delaying taxation on these funds. Investing in life insurance and annuities. This is a topic that gets slammed by some and loved by others. And to cut to my opinion, insurance products can be used for specific investment purposes when all other avenues are exhausted. So for example, a client I worked with many years ago had taxable investments in the $20 million range. Because his portfolio was diversified, he had a significant bond position that was generating taxable income each year. Now his W-2 placed him in the highest tax bracket, so his bond income was subject to taxation over 40%. Even if he had held certain municipal bonds, which are not applicable at taxation, he would have been subject to AMT taxation on that tax-free income. Given his portfolio, he may not have even needed to spend this money, and it could just be passed on to his heirs, so why was he paying taxes on it anyway? So for this reason, it was decided to put as much of his bond portfolio as was allowed into an annuity. One annuity product allowed him to use a stripped-down, no-frills annuity and eliminate many of the fees associated with this type of product. He was then able to defer taxation on this part of his portfolio and would most likely defer it to his passing and to his heirs. But I'm sure you're looking at this video saying, I don't have $20 million. Because, yeah, if we all did, life would be very different. Still, if it's likely you won't use part of your taxable portfolio during your lifetime, sheltering it inside of an annuity product can provide you with immediate tax savings. The same can be said for permanent life insurance. Putting money that would have been used for taxable bond positions into a life insurance product can shield you from paying taxes on the income it currently throws off. Now this philosophy, called being your own bank, is discussed when using life insurance and relates to overfunding a policy by paying more than the premium so the cash value grows faster. Now you use this so you can then withdraw some of that money and it creates a steady amount of income later on in life. When you do this, you have to be very selective with the life insurance policy you use and finding a cash value that pays a high rate of interest. And it can make this approach quite challenging. Investing in a non-public company. Now, traditional investing takes place using companies that are publicly traded. When you invest in your 401k or a taxable account, you're doing so in companies that have filed to go public and then listed on a public exchange. They can be small, they can be big, they can be in the US or anywhere around the world. But by giving everyone access to investing in them, it does not give investors a chance to achieve monumental gains in their position. For investors who want to take the risk in private companies for the chance of these monumental gains, then it can be done in two ways. For investors wanting small companies, they could use a business broker or an attorney to find these companies and see if they need outside investors. These brokers and lawyers can then draw up terms making sure everyone is treated fairly. By making significant cash investments into a company, then an investor can own a portion of that company that would be hard to afford on a public exchange. Imagine trying to purchase 10% of a publicly traded company. It would be very expensive, costing millions of dollars. But for smaller, non-traded companies, it could be done for hundreds of thousands of dollars. You can also become an accredited investor, which by verifying your income and investable assets, companies who've gone through seed rounds with venture capitalists will allow you to become an investor. You would provide a certain amount of money to a private fund and they would invest for you, sometimes allowing you to specify which companies you'd like them to invest in. It's not as transparent as using a publicly traded mutual fund, but this approach can gather some outsized gains. There are many alternatives to your standard investment philosophy, but you do need to do the basics first. The world of investing has many alternatives, but for most, investing in global stock markets through traditional mutual funds and ETFs is the best way to grow your portfolio. If you'd like to explore your situation and see what investing approach works for you, you can contact me and we can design your situation. Until next time, enjoy the day.